Good morning. Capital raising structures for CMBS and agency acquisitions. So, in the world of commercial real estate, capital is the fuel that drives acquisitions, refinances, and development. But for institutional grade transactions, particularly those involving CMBS or commercial mortgage backed securities, or agency loans like Fannie Mae, Freddie Mac, or HUD, and they illustrate how capital is raised can make or break your deal. So, what are CMBS and agency loans? CMBS loans are securitized, commercial mortgages pooled into and sold to investors, offering fixed rate, non recourse financing for stabilized assets. Agency loans, on the other hand, are government sponsored programs that finance multifamily properties with favorable terms, especially for affordable housing and stabilized communities. Both lending types require sophisticated capital structures to ensure compliance, mitigate risk, and optimize returns. So let's take a look at some of the common capital raising structures. Number one would be a joint venture. So a JV structure allows an equity partner, capital provider, and a sponsor or an operator to share ownership and profits. Example, an institutional fund contributes 80% equity while the sponsor invests 20% and manages the deal. Now, the benefit there is that the sponsor leverages outside capital to control larger assets. Number two, you have a preferred equity structure. And this hybrid structure sits between debt and equity. And preferred investors earn a fixed return before common equity will see profits. So the benefit there is it offers predictable income and mitigates downside risk for capital partners. And here's a use case, often paired with CMBS loans for acquisitions with value add components. So, three, we look at mezzanine debt. Mezzanine financing fills the gap between senior debt, CMBS or agency, and the equity required to swing the deal. The benefit there is it allows sponsors to reduce equity requirements while also still remaining in control. Now, the word of caution there is it carries higher interest rates due to subordinate positions in the capital stack. Number four is syndication. So for smaller investors, syndication allows pooling of funds into a single LLC that owns the property. The benefit there is it's diversified access to institutional grade deals. And here's a use case. So common in multifamily agency acquisitions is the thought process there. Number five, you have crowdfunding and private placement. So online platforms now enable direct to investor capital raising for CMBS and agency backed projects. The benefit here is it has access to a broader investor base without institutional red tape. So here's the key takeaways for the day. CMBS and agency acquisitions thrive on well structured capital stacks. So you have to balance your risks, your control of the project, and the yield really is going to determine the investor appeal. So, working with an experienced commercial mortgage broker or real estate broker at the EXP Commercial Viking Enterprise team ensures you have access to top tier lenders and capital partners. So, here's some Houston market insight. The Houston Metro, particularly Katy, Fulshire, and West Houston, has become a magnet for institutional grade investments with strong rent growth, logistics expansion, and infrastructure investment. Sophisticated capital structures are helping investors scale portfolios efficiently while maximizing the leverage they can obtain under CMBS and agency programs. So here's my final thought for the day. Capital raising isn't a one size fits all strategy, and understanding which structure aligns with your investment strategy and loan program is crucial. Whether you're targeting a stabilized multifamily deal under Fannie Mae or a large industrial acquisition with CMBS financing, smart structuring drives scalable growth. And that's it for the day. Have a good one.